If they buy their oil from Venezuela, they have to pay a 25% tariff to do business with the United States.
Is that on top of existing tariffs? So, for example, China...
Yes.
In just a few short weeks, U.S. crude oil exports dropped by as much as 80%. The sudden plunge sent oil prices into a nosedive, forced drilling operations to shut down, and threw the entire energy market into chaos. People across the country began asking, was this one of Donald Trump's most reckless decisions, or the beginning of the worst oil crisis in modern U.S. history? On April 2nd, 2025, former President Trump stunned the world with a bold and controversial announcement: a 25% tariff on any nation that imports oil from Venezuela. As he put it, the objective was straightforward: to strike directly at one of the last financial lifelines of Nicolas Maduro's regime and choke an already struggling Venezuelan economy. But the fallout wasn't limited to Caracas. The most immediate and severe consequences were felt at home in the United States. American businesses, consumers, and the energy industry suddenly found themselves staring into an uncertain future. Described by many as a heavy-handed move, Trump's decision placed the U.S. energy sector in a risky and unpredictable situation. On his Truth Social platform, he declared April 2nd as Liberation Day for the U.S. economy, calling it a turning point in his evolving trade war strategy. But behind the patriotic branding was a display of political muscle disguised as economic justice. At first glance, the idea appeared logical: punish countries that continued to support Venezuela by increasing economic pressure, without firing a single shot. On paper, it looked like a smart diplomatic play. In reality, it turned out to be a costly misstep. Rather than achieving a quick victory, the move backfired, unleashing an economic shock that hit the U.S. oil and gas industry hard. Energy companies in Texas, North Dakota, and along the Gulf Coast, many of which had built business models around steady exports, were suddenly thrown into crisis. Ironically, the burden of the decision landed squarely on the very people the Trump administration claimed to be protecting. Although the policy technically targeted only Venezuelan oil, the global oil market was already strained and fragile. The shockwaves bounced back to the U.S. almost immediately. Traders, executives, and analysts were blindsided by the market's response. Crude oil futures collapsed across the board. What had been framed as a strategic win quickly turned into a major blow to the American economy. The energy market isn't isolated. It's a tightly connected global web. A single, aggressive move in one corner can trigger a domino effect around the world. That's exactly what happened. The 25% tariff on imports from any country that continued buying Venezuelan oil officially took effect on April 2nd. The reaction was swift and brutal. U.S. oil and gas companies, accustomed to relative stability, were suddenly thrust into volatility. All the growth models, built on assumptions of reliable trade routes and predictable markets, were wiped out overnight. Many firms had invested billions based on the belief that international commerce would continue to flow smoothly. That confidence evaporated in a single announcement. The tariff didn't just target Venezuela, it spooked investors, reduced refinery profit margins, and disrupted supply chains already under pressure from conflicts involving China, Russia, and OPEC. On top of that, Trump's public accusations that Venezuela was sending criminals to the U.S. further inflamed tensions and added fuel to an already unpredictable situation. By penalizing countries that still relied on Venezuelan oil, Washington didn't isolate Caracas. It pushed those countries to compete for limited supplies elsewhere. That included crude from the U.S. itself, creating unintended competition for American producers. That's when things truly began to unravel. As multiple nations scrambled to replace Venezuelan oil, global pricing structures collapsed. Instead of rising, oil prices fell sharply, slashing revenues for U.S. companies and undermining profitability. Worse still, some international buyers walked away from contracts with American suppliers, fearing continued instability and the risk of further policy shocks. What was meant to damage Venezuela ended up weakening America's global standing in the energy sector. Oil producers found themselves with unsold inventory, full storage tanks, and ships idling at ports. Investors started dumping energy stocks, and years of hard-earned growth vanished almost overnight. The White House tried to frame the move as a show of strength, but from Texas to Louisiana, companies were left scrambling to contain their losses and wondering if the industry could recover before things got worse. By then, trade data already hinted at declining demand, and although OPEC-led supply cuts provided some price support, it wasn't nearly enough. The energy sector was already operating on thin margins. The tariff hit it like a punch to the gut. In a single night, the price of West Texas Intermediate, WTI crude, the key benchmark for the U.S. oil market, fell below $60 per barrel. For everyday Americans, it might have meant saving a few cents at the gas pump. But for oil and gas producers, it was a red alert moment. It was the first time since April 2021 that WTI had dropped so low, and the timing couldn't have been worse. Industry leaders had just finalized their budgets for the second half of 2025, expecting stable or slightly rising prices. That assumption collapsed almost instantly, casting a shadow of uncertainty over the entire sector. The drop wasn't gradual. It was more like a free fall. Within days, oil prices had shed as much as 15% from their peak earlier that same week. This is where the damage really hit. For most U.S. shale producers, the break-even point sits between $60 and $65 per barrel. When prices dipped below that range, every barrel extracted turned into a financial loss. Producers were left facing hard choices: suspend drilling operations, cut back budgets, or dive into expensive short-term hedging contracts. This wasn't just about lower profits, it was about survival. Many people forget that modern oil extraction, especially in shale regions like the Permian Basin, remains extremely costly despite years of innovation. Expenses such as land acquisition, drilling, transportation, and regulatory compliance continue to rise. Oil companies can't simply drill whenever they want. They have to plan months or even years in advance. And that planning depends on one critical factor: price stability. That's why the drop below $60 sent a loud and clear message. Previous business assumptions no longer applied. Expansion projects were abruptly halted, new developments were shelved, and many firms began considering layoffs just to stay afloat. The number of active oil and gas rigs had already been declining since the start of the year, and this downturn only accelerated the trend. At the same time, U.S. refineries and fuel distribution systems were facing crises of their own. Falling crude prices didn't automatically mean cheaper gas for consumers. In fact, the opposite often occurred. Due to the chaos caused by new tariffs, many refineries were scrambling to find substitute crude sources. These replacements were often more expensive, and those extra costs were passed directly to consumers. The result was a frustrating paradox for American households: gas prices rising at the pump, even as crude oil was crashing. The public outrage was swift, and the media quickly picked up the story. Wall Street didn't offer much relief either. Panic spread through the financial sector, driving energy stocks into a nosedive. Investment funds started pulling out of oil and gas, afraid this was the beginning of a much deeper downturn. What they saw wasn't just a price drop, it was a collapse of confidence. The sector, already under stress, was losing its ability to predict or shape its future. And all of this was unfolding in the context of escalating global political tensions. With uncertainty growing, the energy sector began preparing for even more difficult times ahead. Then came another twist. Just a week after the tariff-driven chaos began, the White House abruptly changed course. On April 9th, 2025, President Trump announced a 90-day exemption on Venezuelan oil-related tariffs for all countries, except China. It was a sharp policy reversal, clearly aimed at cooling the market, reassuring US allies, and avoiding a full-blown global energy crisis. But the message was inconsistent. The administration remained tough on Beijing while extending an olive branch to everyone else. Traders responded immediately. Brent crude surged past $65 per barrel, and WTI rebounded to around $62.35. Prices didn't return to earlier highs, but the drop was at least halted. However, this wasn't a recovery based on fundamentals. It was driven entirely by market sentiment. What this moment proved was just how fragile global oil markets had become. A single comment, a press conference, or even a vague policy signal from Washington could cause billions of dollars to vanish or appear within hours. This fleeting rebound exposed the deeper issue. This wasn't a market-driven downturn, but a policy-driven crisis. For US oil and gas producers, the 90-day exemption felt like a moment to catch their breath. Some companies quickly locked in more favorable short-term contracts or hedged their risks to protect against further volatility. Others paused layoffs or kept production steady, at least for the time being. But no one was truly comforted. Industry leaders understood this reprieve was temporary. China remained under full tariff pressure, and there was no guarantee the exemption would be renewed beyond summer. That uncertainty left most firms unwilling to make major new investments. Long-term drilling and exploration plans were simply too risky under such unstable conditions. What made the situation even more complicated was the uneven way the policy was applied. With China, the world's second-largest economy and one of the top buyers of oil, excluded from the exemption, the international message became murky. Some countries saw the exemption as a relief. Others feared they'd be the next targets. And Beijing was unlikely to sit back quietly. Retaliatory action was expected, which only added more strain to an already fragile global economy. Amid all this, traders stopped focusing only on current prices. The real concern had become political volatility. Confidence was shaken, and the rules of the energy market seemed to change with each new announcement. Oil and gas producers were suddenly forced to reassess everything. They had to start recalculating scenarios, not just for the next quarter, but for the next month, even week by week, because any sudden policy shift could flip the market upside down in an instant. When the US announced a pause on new tariffs, excluding China, which still faced a steep 125% rate, the markets reacted with elation. The move made one thing abundantly clear. The energy market was tracking every detail, every statement, every policy update. It also exposed a deeper truth. Tariffs aren't just tools to punish geopolitical rivals. They're powerful forces that reshape how oil crosses borders, how companies plan their investments, and how traders manage risk. A single sentence from the White House could cause millions of dollars to disappear or be made, depending on who reacted fastest. At this point, the market had become a high-stakes game of timing, tension, and interpretation. Within the oil and gas industry, there was a growing sense of instability, a belief that the rules could change at any moment, and that made the future harder to predict than ever before. At the same time, China, still the world's second-largest economy, was showing signs of slowing growth. Meanwhile, global oil supply was booming. It was a perfect storm. The moment tariffs hit and oil prices began to tumble, trading floors around the world descended into chaos. It felt like a new Black Monday for energy markets. At the Intercontinental Exchange, the volume of futures and options trading in Q2 of 2025 surged to record-breaking levels. Over 219 million contracts changed hands, compared to 181 million the previous quarter. This wasn't ordinary market activity. It was a panic-driven explosion in trading that reflected widespread fear and uncertainty. From hedge funds to major oil companies, everyone scrambled to protect themselves. Long-term planning went out the window. Survival became the priority. The situation had also escalated far beyond Venezuela. Washington had just hiked tariffs on Chinese goods up to 125%, and speculation was swirling about extending sanctions on Russia. In the Middle East, OPEC Plus struggled with internal divisions over production levels. Every one of these factors collided at once, turning the oil market into a dangerous balancing act. For traders, it felt like juggling live grenades. One misstep, or a single unexpected headline, could trigger a market explosion. Traditional supply and demand forces no longer dictated prices. Instead, fear, rumors, and political drama took the wheel. A tweet, a press conference, or a leaked report from Washington, Beijing, or Riyadh could send oil prices soaring or crashing within seconds. Rather than building long-term strategies, Many traders were left reacting minute by minute. Some even placed bets against themselves just to stay protected from every possible scenario. It was a reflection of just how unstable the market had become. From the outside, all of this may have seemed like financial theater. But for the people on the ground, those extracting, refining, transporting, and selling oil, it was a serious crisis. Determining the actual value of oil had become nearly impossible. One day, prices would plunge 6% due to tariff announcements. The next, they'd jump 4% because of rumored exemptions. While prices swung wildly, companies had to make real-world decisions. Should they keep drilling? Should they sell now or store inventory? Many no longer trusted any price point as a basis for planning. Risk management teams were pushed to the limit just trying to keep up. Entire strategies for the year had to be torn up and rewritten. To prepare for worst-case scenarios, companies bought extra insurance contracts, knowing full well this would cut into profits. Meanwhile, banks and brokers raised fees and tightened lending terms, adding more pressure to an already struggling industry. For small oil and gas firms, this was a nightmare. Without the scale or resources to absorb repeated losses, one wrong hedging move could mean bankruptcy. This wasn't the first time the US oil sector had played a stabilizing role in global markets. During the 1973 oil crisis, when OPEC cut supply and imposed an embargo, crude from the Permian Basin helped the US hold steady. History has shown time and again that oil demand tracks closely with global economic health. When factories are running, flights are full, and highways are packed with trucks, energy use climbs. But by the second quarter of 2025, that trend had stalled. Data from the International Energy Agency showed that global oil demand growth had slowed to its lowest pace in years. This wasn't just a local slowdown, it was global. Trade tensions, weak industrial output, and widespread policy uncertainty triggered a ripple effect across markets and industries. The single biggest driver: escalating trade wars between the world's largest economies. The US was locked in a standoff with China. Sanctions on Russia were tightening. Even within the Western alliance, disputes over tariffs, supply chains, and energy security continued to escalate. The result? Business confidence plummeted. Manufacturers slashed orders. Shipping volumes dropped. Business travel was delayed or canceled. A logistics company faced with high costs and low demand would avoid stockpiling fuel. A factory unsure of whether parts would arrive on time would scale back production. That caution spread across the global economy, leading to less fuel consumption, despite an oversupply. For US oil producers, this was more than just bad news. It was an existential threat. Refineries had based their production on rising demand. But when buyers pulled back, those calculations fell apart. Unsold fuel started piling up. Inventories surged in major hubs like Cushing, Oklahoma, and along the Gulf Coast. When storage tanks start to fill up, it's a clear sign that supply has outpaced demand. A worst-case scenario for the oil industry. Even more concerning is the effect this has on prices. In many instances, oil for future delivery became cheaper than oil for immediate use. This unusual pricing situation is known as contango. While it can create short-term opportunities for storage traders, it also signals a market flooded with excess supply. With fewer buyers, many producers decided to hold back, hoping to wait out the storm. But the longer they waited, the more inventories piled up, and the more pressure there was on prices to fall. At the heart of this crisis was a single, powerful factor: uncertainty. The problem wasn't just falling demand, it was that no one knew what the market would look like tomorrow. Energy analysts across the board began to lower their forecasts. Traditional importers either slashed their orders or shifted to regional suppliers. US oil, once the shining star of an export-driven boom, suddenly found fewer takers. It felt like preparing a banquet, only to find that no one showed up. The message was loud and clear. As long as trade conflicts and political tensions continue to dominate headlines, businesses will remain cautious, fuel consumption will stay low, and the momentum behind America's oil boom will remain stuck in neutral. Domestically, there's no question that the US still needs energy. The Trump administration has consistently emphasized its goal to lower gas prices and ensure energy independence. For years, the American oil industry surged ahead with remarkable speed. Fueled by cutting-edge drilling technology, advanced data analytics, and strong global demand, rigs across Texas, New Mexico, and Louisiana were operating near full capacity. But by mid-2025, that momentum began to stall. A report from the Federal Reserve Bank of Dallas showed the first slowdown in oil exploration and production activity in years. The Business Activity Index dipped into negative territory, a clear sign that companies were no longer expanding, but starting to pull back. The reasons weren't limited to just one issue. Prices had fallen below profitable levels, hedging costs had spiked, and the uncertainty surrounding trade policies had shaken business confidence. The combination of tariffs on Venezuelan oil and intensifying trade tensions with China triggered a wave of anxiety throughout the sector. With prices falling and volatility rising, financial planning became nearly impossible. Producers were forced to rethink every move. Even in areas where land was secured and permits approved, many companies decided not to drill. In this unpredictable climate, investing in a new well was no different than gambling during a storm. No one could predict the outcome. Take the Permian Basin, for example, once the heart of the U.S. shale oil revolution. Activity there has slowed significantly. Companies that had once raced to secure drilling rights and equipment are now considering layoffs or renegotiating contracts with service providers. Smaller companies have been hit the hardest. Without deep pockets or easy access to credit, they've been left with little room to maneuver. Many have had to suspend projects indefinitely. Some have walked away from leases they can no longer afford. Others have gone a step further, shutting down operations completely. Even those still operating have changed their approach. They're prioritizing wells with reliable output and shelving riskier projects. Across the board, the new mantra is capital discipline. Investors are no longer rewarding fast growth. They want to see stability, sustainability, and smart financial management. That means fewer wells, slower growth, and an increased focus on hedging to protect against future price shocks. But even hedging has become more expensive. Banks and lenders, still reeling from the recent market volatility, are tightening conditions. As a result, capital is drying up, making it even harder for companies to invest or expand. The optimism that once defined the oil and gas sector has quickly faded. Hiring has come to a standstill. Equipment orders are down sharply. Even large corporations, while still operational, are running on scaled-back budgets. The spirit of aggressive growth has been replaced by caution and retreat. Many veterans of the industry are drawing comparisons to previous oil crashes, times when prices collapsed seemingly overnight and recovery took months or even years. And now, the question shifts to you. How do you see the road ahead? Please subscribe to the Timefall channel and don't forget to like.